Hi everybody, welcome to this week's edition of the Middle Class Investor. This is Seth Martin, and today is October 10th, Friday, October 10th, and we've got the familiar rising wedge on the screen. I'm going to zoom in here to the latest activity, which was it was something else. I tell you that this week was a very aggressive selling week, as you can see here. This red bar here represents the week, and we sold off pretty strong. I'm going to zoom in on like a 6-month chart here, and you can see here that we chopped around, but in a downward direction inside this kind of expanding cone type of pattern here. This is pretty typical of kind of a topping action in the market. The market doesn't just go straight down, as you know, or it doesn't go straight up either. There tends to be a battle between the bulls and the bears, trying to agree on price, and and there's just a lot. You can just see a lot of tug of war in this price action. This day right here, let me zoom in. This let's talk about a little bit here and there. This big white candle day right here that we're looking at. This was that's not what I wanted to do. This was the Fed minutes day. You could see the market was weak. It was coming down and found a bottom here, and the Fed said what it said. I don't even know what it said, and the market rallied up. Of course, this is the way news is going to be in really in bear markets. It tends to be this way. You can have a good news, and it'll create like a relief rally, and then the trend will resume. So basically, whatever the Fed said, the market came back and just took it right away the next day, and in fact the next 2 days. And I would expect this to be like this for some time. Let's zoom out a little bit. Let me look at a 9-month chart. You can see here where we've got our support lines. The reason I'm saying that it'll be here sometime, actually, that's pretty vague, and I'm going to be a little bit more specific. Actually, the market sold off another 10 or 12 points below this level after the close. So it actually got down to like 1893 after the close. So after the market close price made it below this previous low from when was this? The July low? I can't remember when that was. Let's look real quick. This was the August low. This was more recent than July. So the market is actually going to, on Monday, should open up below this level here. Now, let's back up and recap a little bit. We broke out of the wedge. We actually broke out of it right here on this day, and then of course climbed right back in it pretty quickly. Then we closed outside the wedge. Okay, so here's the wedge line right here. Here's the upper bound of the wedge line. So on this day right here, we closed outside the wedge. And then immediately the next day kind of opened and ran all the way up and got back in the wedge. And then the next day closed outside the wedge. And now we've got a clean break of the wedge. But what's interesting to me about this is that on this first attempt, it kind of broke out and went right back up to it. But then on this one, it really went and if I had this line, you could draw this line probably a couple different places, but it's interesting how it went right. I mean, you can tell that this is a real battle going on at this particular location in the market, and finally it gave way. And I think what you'll see the market. It could sell off. It's probably going to end up selling off below this box, because I think we'll get a little bit more selling, another bounce here, and then another. I think this 1844 will probably hold, and then we need to be looking for what to do. So year to date, the gains for the market are gone. So basically, at least in the Dow, maybe not the S&P, but the Dow, the Russell 2000, the Russell 2000 or 4000, I can't remember. The mid-cap 400, all those major indexes are all down now for the year as of today. So the S&P might be the last one standing. Let's see where January 1st is. January 1st is right there. So the start of the market day on January 1st is right here. So the S&P, or let's say December 31st, it closed right there. So the S&P is still up for the year, but it's the only index that is so, and it has cleanly broken out of this rising wedge pattern. So that doesn't portend good news for the overall broad market. Let's go back to a 5-year chart, and let's look at the interest rate market. This is the 10-year Treasury. It looks like to me this is going to give way. It's hard to say for sure, but it looks like we're going to go down here and maybe test this 2% interest rate level before we resume higher prices. I still think it was prudent to mention this level and recommend that you not be in bonds or bond funds as we were coming down into this level. But if you're still in bond funds, you actually might make a little money as we move down into this level, because I'm not sure this level is going to hold. I think we're probably going to come down into this level, especially if the market sells off. There's a tendency for money to flow. If money's flowing out of equities, it tends to flow into bonds, at least temporarily. Let's look at the Dow Jones. The Dow Jones, like I said, is today is officially down for the year. This pattern, I zoomed in a little too close. What's the date on that? Yeah, this is October. There we go. This pattern is also very bearish on the Dow, and that's why I drew it with these trend lines. This whole move right here is 1 year, okay? And when you get, this is kind of a rising wedge type of scenario. And a lot of times when you get one of these, you get one of these at the topping part of the market. And I would say this is probably going to come down to this support line, probably retest this trend line, and then you're going to see this come all the way down here to 14,500. So, this is just a very typical pattern, the way this is traced out here, and once it breaks out, usually traces back to the origin, which is right here, and that's just typical of this pattern. So look for the Dow to come down here to 16,250-ish, this line right in here, and then bounce. So let's just, since we're talking about that, let's talk about what that might look like. Let me before I do that, let me go to a daily Let's look at like a 6-month chart, and then let's zoom in. So let's say that let's say the market continues to sell off into into this area right here. What you're going to be looking for is a move that kind of looks like this, right up probably to this 16,800 area, and this would be a great place to sell if you're interested in selling. I realize some of you out there that are listening, you may be listening just to see if any of this happens or comes true, and I understand that. Believe me, and you should actually, before you listen to anybody about your money, you should make sure they know what they're talking about. So, but now that this is broken out of this pattern, I think you're going to see the Dow come here. You're going to see a pretty brisk correction. The market has to do this. It has to correct. It relieves. Basically, what happens is the market falls. They're selling, and eventually you just run out of sellers. Everybody that's going to sell in this move is sold, and there's nothing but buyers left. And then buyers come in and start buying, and then all the sellers that were selling, they start covering, right? So they have to cover, which then accelerates this move up. So these correction moves are very rapid. In fact, it's usually about if this took, let's say this takes 15, 16 days, you could see the up move take half that time or even less. So it could be very rapid upward movement. Okay? So let's go back again to a longer term chart. I like to look at a weekly when we're doing the big overview here. Here's the euro, and I think we talked about the euro last week, about this probably holding, and it does look like it's held so far. And then we also drew some trend lines here and here, because it looks like maybe the euro's kind of consolidating inside of this pattern, and I'm sure at some point it'll break out, but it looks like to me this is going to hold at least temporarily. So maybe we come down and test this trend line, make a move back up, and then I'd say, I don't know, it's hard to say at this point, but my guess is that the euro breaks to the downside. There's a lot of talk about the euro and the dollar moving to parity, and we'll look at the dollar in just a second. I want to look at the NASDAQ though, because this was I mean, this was one heck of a move today. I don't know if you can see up here, the NASDAQ went down 102 points. That's what this red bar is. Actually, that's for the week. But check out this daily move. I mean, that is something right there. So the market closed right here at 4,378. It gapped down to 4,354 and just kept on going. And of course now you can see that it's at support. So at least temporarily, I mean, you might get a little bit more downside to this move, but at least temporarily, maybe the NASDAQ will slow down, bounce a little bit, and then resume. I don't know, maybe down into this area, 4175, something like that. So we'll just have to see what's going to happen with the NASDAQ. The volatility index continues to accelerate upward. This trend line's held, and in fact we can probably draw. Sometimes when you see a trend line becoming more aggressively upward, you can put in another trend line like that. These trend lines are just helpful for you to see things and for me to see things. It doesn't mean anything. It doesn't mean that the VIX couldn't sell off and come through here. Certainly that could happen if you know, the market participants drove the market higher then the VIX would in turn, sell off. So the VIX was up 13% today. That's a pretty good move. The S&P 500 was down 1.15%. So that's quite a bit of fear, I would say. This day was bigger. This day here was much bigger than this day, but that's still quite a bit of fear in the marketplace. So I think that's, it's healthy to respect that. I think you'll see that increase as the market continues to move. Let's look at gold. Gold is /GC. Again, this was the high from 2011, if you can believe that. It goes back to 2011 now. And we've been making this move down. We had this consolidation. We broke out of the consolidation. What's interesting here, and I had put this line in to point out its importance right here. But what's interesting, we broke out of the consolidation and quickly went right back up. So I would say you could see gold kind of retest the middle of the midpoint of this this pattern, and then maybe it keeps going, but looking at the dollar, it looks like maybe it's going to come up here a little bit and then roll back over and make a new low. I still say that gold is going to break out of this consolidation and make a new low, a low lower than this low from this is from June 2013. Let's see, it was about 1179, 1180. So I think you're going to see gold go down to 1,000 or maybe even a little bit below 1,000. Let's look at the dollar real quick. The dollar, important right now. It's driving a lot of what's happening in the market. You can see this move in the dollar. I mean, it's hard to see in the last several years. I mean, this goes back to 2010. This was a strong move in the dollar. This move from November 2009 to June of 2010. But really, the rest of this is just chopping, chop, chop, chop. This, I mean, there's almost no chop here. Look at this move. This thing is on rails right to the moon. And it looks like it's pulling back, or maybe has finished pulling back. It's hard to say at this point. And I suspect sometime next week or the week after, the dollar will resume this trend and probably take out the highs from back here. So I don't know if we can see that or not. We really can't see that. The high was 88.905, and we're at 86.87. So we're probably looking at coming just off the screen here. And of course, at some point the dollar will correct. If you want to be long the dollar, if that's something you want to invest in, which I don't think is a bad idea, you might look for the dollar to pull back. We talked about the dollar. Maybe it's probably not. I mean, it might be through making its highs for now. And if it pulls back, it's likely to pull back into this 2220 area on the UUP. This is it means the U.S. dollar up. So if you think the U.S. dollar is going to go up, look for a pullback into this below 2230 area to go long. And I think you can pretty much just put that in there and leave it for a while, and I think you're going to make some money on the dollar. I don't have anything to show you from the web today or anything like that. I think there's fear building in the market. I mean, we're still very. I mean, if you look at a weekly chart, even if you zoom in, I mean, we're still way close to the high. So, I would say if we get down into here, like I suspect we will, and we get a swift correction back up in here to the 2000 area, I think you got a really good chance of getting out of your 401k or going to cash and missing what could be a very substantial fall in the market. We talked about the market going down to at least the support of this level here, and potentially even back here to 1625 or so. So this level of support right here, okay, would be the first stop. And so, you know, let's just make a little picture of what this might look like, just so you can, I guess, so you won't be surprised if you see it. You might see, you know, the market come down here. Whoops, let me use straight lines. You might see the market come down here into this area, maybe come up a little bit, and then down into this area. I would say not lower than this area. And then you're going to see a really swift rally. I mean, people are going to be talking about how that's it. And you might get up, it might get all the way up here and just north of 2,000. But not necessarily a new high. Now, if it makes a new high, all bets are off, let's go higher. But if it doesn't make a new high and turns down right here, this would be a great place to go to the sidelines and just watch it from the sidelines, because this move right through here is going to be very, very swift, and it's going to create a lot of fear in the market. And the best place to be when stuff like this happens is on the sidelines. So something to consider, but I would expect the market to move down something like this inside of this expanding cone. Once it breaks out of this cone to the upside, you'll know that we're in a corrective phase, and look for the market to correct to the underside of this rising wedge, and then it may not make it all the way, or it may pierce it slightly and then sell off. But if it doesn't make a new high, then adios amigo. You want to be out of that. Be on the sidelines. It's a good place it's a very comforting place to watch from, and not feel any anxiety about your retirement and things like that. You know, look, especially if you're a little bit older, it's so hard. I mean, you can see how long. Let me just back up. Let's look at a 10-year real quick. You can see how fast this money evaporated and how long it took to make it back. You know, I mean, this is torture, right? I mean, for let's see, let me measure this from the high in 2008. Is that 2008? What is that? 2007. So October 2007, October again, huh? Isn't that interesting? So from the high in October 2007 to the low in March of 2009, that was 518 days. It took measure from here to, say, here. Then from here to here, it took 3 times that many days just to get back to even. Okay. And then it took 4 times as long to get, you know, a 25-30% gain, let's call it 25% gain out of that. So, you know, some of you just don't have that much time. I mean, you can't afford to take this kind of loss and then wait this long to get it back. So I still contend that Now, I'm not saying that every bear market you should try to hit, but it's my opinion that this one's going to be a doozy. And like this one right here, maybe you live through. I mean, I'm sorry, not that one. This one right here is the one I was thinking of. This one that happened in 2011, you know, where Europe really came unglued. Maybe you lived through that one. You know, it was about 20%. But these right here, like this right here, or this right here, you shouldn't have to live through these. These are very big. And I don't know if you noticed, but they're getting bigger. Like the up moves are getting bigger, and the down moves are getting bigger. So this down move is smaller than this down move. This up move is smaller than this up move. And I would say the odds are this next down move will be bigger than this down move. So just for grins and giggles, let's measure this down move. This one was roughly 56%. So, and if this is of the same magnitude, okay, that means, notice how this low is higher than this low. That means this low, if it sells off that far, would be lower down here. It would be lower than this low. So you just can't live through that. I mean, who knows how long it took? 6 years for this to come back. Who knows how long it'll take for this one to come back? I mean, can you imagine how many people are going to be just sour on the market if this were to go all the way down to here? And I know there's some of you out there saying, there's no way it'll do that. I mean, that was a once in a century, once in a lifetime event, that 2008 sell-off. Well, one of the things I've learned about the market is it can do anything. There's nothing impossible in the stock market. And the quicker you come to understand that, the quicker you'll be able to make money and also keep from losing money. So that's it for today, middle-class investors. I really don't have anything else. I'd look for this to come down into support, maybe make a little relief rally and then sell off a little bit more before we get a counter trend. I just don't think this has taken long enough. I think it wants to take a little longer. Maybe come down into this area, maybe 1810 before it comes back up. And some of you out there, you might need convincing. You might need to see, 1840 on the S&P, which would be, let's see what that would be. That would be a loss of 9% in 3 weeks. So, 9% loss in 3 weeks might convince some of you that hey, this is serious business, and maybe I should get prepared to take some action if we get a relief rally up into this area. So, anyway, not trying to scare you, just trying to prepare you. If you have any questions, you can comment on the YouTube channel. That's at Middle Class Investor. The address is a convoluted address. If you just go to YouTube and search on Middle Class Investor, you'll find it. You can also go to @InvestorClass on Twitter and find the links to the YouTube channel there. You can also play them from your phone from that link, or from YouTube on your iPhone or Android. So that's it for this week, everybody. Thanks a lot for coming in and watching the Middle Class Investor. Be careful in the markets, and hope to have you in next week. Thanks a lot. Take care. Bye-bye.